So are you an investment property owner and you're looking to defer your taxes through a 1031 exchange and you have some questions about it? Well, we definitely have the solution for you right here. You're going to want to watch this video. Hi, this is John Dehart with the Homes from Dehart Real Estate Team, powered by Keller Williams here in McLean. And I am with the guru, Bill Horan. We're here for the second video in our series of how to defer taxes if you're an investment property owner. So Bill, thank you again for being here.
Thank you.
We discussed some of the high level parts of what it takes to do a 1031 exchange. And today we're actually going to get into the nitty gritty. We're going to get into the details because we all know the devil's in the details, right?
Right, absolutely.
So one of the questions that we have a lot is, if I'm a property owner or an investment owner and I own real estate, I want to sell my property and maybe go into some sort of a partnership with somebody. How does that all work? Is that possible through a 1031 exchange?
Yeah, no. So exchange is a property owner gives up property. Let me just use it as a simple example. Bill sells a property. And so Bill is the tax owner of the property. It's on my tax return. I've added that rental income, depreciation, all that normal stuff. I'm moving my investment. I'm exchanging it for new investment. So I've got to be the owner on the replacement side.
Okay.
So it stays on my tax return. Here, I gave up this property and I bought this property and I stay. If I want to go in with others, I could buy as tenants in common. So I can have multiple owners on a property on the deed down at the courthouse, but I'm buying a percentage of it.
Okay.
And so that's the goal, is I got to be consistent with the ownership. Bill gave up the property. It's under my tax ID number, my social. My social is on the buy side. So I'm consistent.
So you more or less, if you own property now as an investment owner,
Right.
then you can go into some investments, in some sort of, like if you're a trust or an LLC, you more or less have to buy through that same entity.
Yeah.
Is that correct?
Yes. So Bill Horan sells. I'm staying with my simplistic example. And it's under my social. It's on my tax return. There's a couple of exceptions when I go to buy the new one. I could buy the new one with my revocable trust, my grantor trust.
I see.
So I'd say Bill Horan, as trustee of Bill's trust, is the owner of the new one.
I see.
Revocable trusts do not file tax returns. They're disregarded. So it's still me that sold and bought. But deeding at the courthouse is my trust.
I see.
The same with an LLC. I'm selling an investment property. I've gotten advice that I should own the new investment property in an LLC for some protection purposes. So as long as I'm the sole member of the LLC that takes title, it's still me. It's my business. It's under my Social Security.
Okay.
It stays on my tax return. So I've just got to be a sole member. Where I'm going with this is you can't join into an LLC and become a partner. The minute you put two people in an LLC, you create a partnership, even a husband and wife, unless we're in a community property state, which we're not in. So you just got to be the sole owner of the LLC that's on deed of the property. And then your continuity of investment, you're continuing the investment you.
Okay, so what's interesting is we have one of these going on right now. We kind of talked about some of the high level notes. What we're doing now is they're selling an $825,000 investment. How much gain do they get, or let's just say how much credit do they get when they're actually selling the property? Because there are some fees included in there.
Right.
There's deed fees, there's transfer fees.
Right.
We're actually selling it. There's no buyer's agent involved.
Right.
It's just a direct sale.
Right.
Let's just say they're netting about $800,000 from the sale. Is that how much they get credit for on the deferral?
Yeah. So remember, you're continuing the investment. You're going to sell the thing. And in this scenario, there's no debt on it. So
right.
It's all cash.
It's all cash.
So they have to reinvest all that cash. So there's a gross contract price, whatever fees are there to get out. That's eating into that cash. Got to pay those bills. Whatever cash is left gets reinvested in the new property.
I see.
So because if they start putting money in their pocket, which is okay, they're going to pay taxes on that cash because they're cashing out. And the government views those first dollars coming out as cash out, gain.
Is their money.
Well, it's profit.
Yeah, right.
So the government is your partner on these things, so they want their cut.
Right. So they're basically, like, let's just say the net is about $800,000.
Right. Cash.
Right. So seller has $800,000 cash. They're looking to reinvest. They've actually gone under a contract on a property that's going to be $725,000.
Okay. So there's a delta. Right?
So there's definitely a delta.
Right.
With the fees and everything, it winds up being about $732,000.
Okay. On the buy side.
On the buy side.
Right.
They've already basically, they're going to closing, here in a couple days on the sale. and then, the selling side, and then on the buy side, they're going to closing later on in the month.
Right.
So there's going to be a delta of, let's just say roughly about $67,000.
Right.
How much taxes do they usually have to pay on that?
Yeah, that's a good question. So that's always a CPA question. What's your tax bill?
Sure.
Right, because that's going to hit their tax return as gain. And there's all kinds of things happen on tax returns. So, but just as a general rule of thumb, the federal government has 2 layers of tax. One is the recapture of depreciation. It's a rental property, you've been depreciating. Mm-hmm. And that has we call it a recapture rate. That's $1,250 depreciation recapture. And then the other is long-term capital gains. That's your appreciation. That's 15%. So, and then this is Virginia. So Virginia's got 5.75. So the blended number, my rule of thumb is about 25%. By the time you mix in what the feds want and Virginia wants, it's going to be about 25%.
Yeah, so 100,000, you're paying 25,000.
Yeah, going by.
Yeah. So what do you do with the delta if you can't find the right property?
Yeah, buy more real estate. Yeah, I'll just pay tax on it. It's not the
or
worst
so you kind of do one or the other.
That's right.
You just either buy another piece of property and you get the benefit.
Right. Well, you shelter more.
You shelter more.
Yeah. You still own real estate. Right.
Or you just cash out and.
That's right. Pay your tax on it. It's not a big deal. I mean, we call it a partial exchange. Most of the gain got deferred into the new property, but some came out. So we call it a partial exchange.
Okay. Interesting. So what about if there's an opportunity to, let's just say they bought the property and it was 900,000 and they added more money to it.
Right.
Versus like the 820, the 800, they added more. What happens then?
Well, they just added more money. So they bought a more expensive investment. So they added to their basis. They either mortgage or cash out of their pocket, whatever. They're added to their investment. So they increase their basis in the property. Now they just own a more expensive. And it could be multiples, right? They go from 1 to go to 2. It's just how many dollars of real estate did I give up? And how many dollars of real estate did I own? Right.
And this can be residential property. It could be commercial property.
Land.
It doesn't, like people say like kind.
Right.
But that's not really true, right? It's like, it doesn't have to be a townhouse for a townhouse or a single family for a single family. It could be a townhouse for a single family, or it could be a townhouse for an apartment community or something. As long as you're the entity.
It's real property. For real property.
Real property.
As long as it's held for business use, investment purpose. So,
wow. Yeah.
Yeah. But so it's not a primary where you live. It's not a second home because that's for rich people. And it's not for a flip, which is held for resale. Builders, developers don't do exchange.
Right.
That's just inventory for them.
So you can't do it on your principal. I was going to ask you this. Right. I'm really glad you brought this. So you can't do it on your principal residence.
Right. Well, you don't.
Right. Yeah. The government's
that's section 121. That's different section of code for you.
You have different capital gains, buffers there, already built in, 250 for a single owner.
Exclusion. Right.
Exclusion, and then 500 for a married couple.
Right.
So this doesn't apply to
primaries.
For primary residences.
Right. Correct.
Or second homes.
Right. Right.
Just investment property.
Correct. Which is usually the buy and hold space.
And this can be Airbnbs.
Sure.
So what I'm seeing a lot of people doing is they're trading their Northern Virginia properties that they're renting out for the annual time frames, annual terms for these beach houses, and these mountain houses and these lake houses and all that sort of stuff. So
and run Airbnbs, right?
And running Airbnb, so you can do that. Right?
Sure, absolutely. Well,
now, okay, let's just assume for a second that you want to use your rental property.
Right.
What are the rules on that?
Yeah. So it's pretty clear from the government that they gave us what's called a safe harbor. They know people want to do that. Go into a beach house, play in the beach house, right? Everybody knows people want to do that. So they limited personal use to 2 weeks per year. What happens when you have a rental property and you have a Schedule E, which is your income and expenses on the Schedule E, there's checkboxes on it for personal use. And the minute you go over 14 days per year personally, you start losing your deductions on the property. You can't take your losses against your income. So that seems to be the tipping point with the government. You're okay to use it personally for 14 days per year. But if you go over that, now the government could question what you have. Is it a second home or is it an investment?
Right.
So there's nothing in the code that says 3 weeks is too much. But we have some signaling from the government. If they want to look at the transaction, if they think you've done something screwy, that would be someplace they could put, wait a minute, this is really a second home. It's not really for investment purpose.
So here's the deal. Like, this man could go on for days talking about, this particular, subset in tax code. Before you embark on selling real property, especially investment property, you're going to want to talk to somebody about it, because you don't want to get involved in a bad deal, right? There's a lot of ways that you could potentially get yourself in a lot of debt, a lot of trouble, if you don't do this correctly. Because,
There's a lot of steps.
The process is very, very, very streamlined, with you.
Yep.
And it's not easy to do by yourself. So before you embark on this mission, you definitely want to talk to a real estate agent. You're going to want to talk to Bill and his team. Amazing resource for us, and we can't thank you enough for all this. You're saving people lots and lots of money, which is wonderful. And if you have any questions about that, Bill's number is going to be here on the video. He's with the Realty Exchange Company here. How many of these are you doing a month, roughly, right now?
160 or so a month.
Yeah. So you want to talk to Bill before you do this. So listen, if there's anything we can answer on our end, we're happy to sit down and review some of the options with you as well. And hey, thank you again, Bill. This has been wonderful. And if you guys have any questions, give us a shout. Have a great day.